morning, Sarah. How are you?
I'm doing. I hope you are too.
By grace, I am.
And I'm sure that this whole conversation around the agreement that has been reached between the government of Ghana and, of course, Barry DV Limited would interest you, because there are issues of value for money being raised. There are issues of whether or not this is the best agreement at this time, the structure of agreement. What do you think?
Hello?
Hello, Doc.
Yeah.
I hope you heard me.
Well, I mean, when it comes, I heard you. When it comes to mineral resources, and people talk about value for money. Hello?
Hello, Doc.
Yeah, can you hear me?
Yes, I can hear you, Doc.
Yeah, when we talk about mineral resources or mineral wealth for people, which is in the hands of a government, because government is only playing a fiduciary role by holding it in trust for the good people of Ghana. So what happens is that it's just not value for money you look at across the entire value chain of such a resource, what beneficial interest and what long-term interest has for generations unborn. That should be the fundamental crux of it. You can it's not about running the best regression model of what gives us the best yield, but what is going to happen. And in terms of what we call externalities, at the end of the day, when these mining companies or foreign mining companies pack and leave the country, what externalities are they left us with? How are we going to compensate ourselves for these externalities? Are these externalities greater than the real benefit or actual benefit we achieve from this? Mind you, Chile is struggling out of the ravages of lithium mining and have still not much to show for it. Even though they have, Chile, Bolivia, Argentina is what was known as the, lithium triangle, right? And globally, they are they hold the most deposit of what's now known as the white gold, which is lithium, right? And they themselves are still struggling with it. So there are a lot of practical examples globally that we have to look at to really fix our situation right. And why do I say this? You look at the case of Botswana. Right? Botswana, when it started mining issues or in terms of diamonds, used to still go to Antwerp, right, in Belgium to cut it, because that's where the diamond cartel used to be. But years gone by, they realized that we need to have real value for our diamonds, right? So they had to push a case and make a fundamental point, because what they said was that, look, we have blue chip diamond, and by blue chip, we have premium. Just as we said, we had sweet light crude when we discovered oil and gas resources, right? So why don't we attract the best of the best in terms of a blue chip company? And they brought in the BS. And as you would know, the BS control about 85% of global monopoly when it comes to diamonds or diamond distribution. So in bringing in the BS, they just bring the BS and say, look, come for royalties of 18% and let's pat ourselves at the back to say that we move from a 5% to a 18%. No, they went on a 50-50 partnership, which is that Botswana. So globally, this is by far a classic case of a partnership between a mineral resource-rich country and a multinational corporation. And it stood the test of time. It's giving Botswana its real value for money across the value chain. There are refineries or gem cutting, diamond companies now in Botswana as we speak. So if we have all of these models happening around that, because mind you, just mining lithium is not the actual thing that happens. This is a very, power intensive industry because you need a lot of electricity. So what it means is that we're going to be struggling a lot to have power to do this. It is very water testy, right? So we're going to pump a lot of water into the industry as well. So all of these things have to be looked at in a long-term perspective before signing such a deal. I listened to the CEO of the Minerals Commission, who was arguing on a straw position of comparing what figures the IEA had and what is calculated. It's neither here nor there. What is the model? Can the model stand the test of time? That is what we should be looking at.
Ed, from everything you're listening to, are we adopting the right model, or we are getting it completely wrong?
Well, when you say getting it completely wrong, it's neither here nor there. I would not say that there's a fit for purpose model and this is the right one. But what we're saying is that to pat ourselves at the back to say that, okay, because we've had 13%, it is the best, I beg to differ. Right. We already set up the investment fund. It's getting 6% stake. Why can't we let it get in more? Probably, raise it to about 30% or so. Right. Can we create a company to get in, listed on the Ghana Stock Exchange, issue an IPO to raise revenue to fix this? These are some of the issues that we should be looking at that can give real value for money. For example, you look at the company Atlantic Lithium that is being around with this lithium deal. This was a company that was formed in 2007 known as Iron Ridge. Okay. It changed its name to Atlantic Lithium in 2001. This was probably done possibly with, sound lithium savvy. After the track record of it in the industry, we can't tell much. But we know they have some presence in Côte d'Ivoire, right, recently. Right. So globally, when we're talking about top 2 global lithium companies, we're talking about American Albemarle and Chile's SQM. Right. It didn't lead with these kind of companies. It's among the top 10 lithium companies. Right. So these are all fundamental questions we need to ask ourselves. But in any case, if we have lithium deposit, right, which has a net present value of 1.3 billion and a lifetime revenue of 6.6 billion, right, is the best model for us to give it to get real value out of it, 18% royalty? I doubt.
So even
then again, you look at Atlantic Lithium, right? It's going to operate under a subsidiary known as Green Metal Resources, right? We ask ourselves again, what's their track record? Can we lift the veil to know the ownership and board, right, or shareholders of Green Metal Resources? So these are all interesting questions that we need to answer around this lithium deal. Nobody's against it. Yes, if you have a resource, you have to exploit it to be to the benefit of the entirety of Ghana. But what's happening now? That's a fundamental question.
Now, what we have is an agreement in place. People have called it a fait accompli, which means that it seems we can do little about it. How do we address all these questions you're raising and being raised by civil society when it seems like everything is done?
Well, the point is it hasn't been ratified yet. So once it has not been ratified, there's no deal, as far as I'm concerned, legally, right? So possibly government needs to step in and listen to stakeholders and see how best we can, as it may, input real stakeholder voices, and for that matter, that of civil society and the likes of it that tend to, as it may, be critical of this deal and are calling for the right. We're not saying that all civil society voices are right in this regard. Some of them could not, but it's about welcoming people. I've seen the posture of the CEO of the Minerals Commission, which has not been very stakeholder friendly and it's not been welcoming, because it's not a war between whose numbers are right or wrong. We're looking at a sustainable deal, a fit for purpose deal, a deal that would stand the test of time, a deal that would not need externalities that would outweigh the benefit of lithium, as has happened in places like Chile in the past.
Look, thank you. Thank you very much.
Yeah, thank you so much.
Dr. Sharif Mahmud Khalid is Associate Professor of Accounting and Financial Management at Sheffield University, joining us. He says there's still a lot of questions that need to be answered before we finalize any arrangement.